Two stocks I'm buying in May of 2026. We've had an amazing recovery in the market, trading at all-time highs in just 11 days. And many people believe there's no more opportunities in the market and the market is too hot. And I kind of agree with that. But most of this rally has been mainly based on AI, semiconductors, AI infrastructure in general, Caterpillar, and transformer-related stocks going from 10 PE to 35 PE. It's getting ridiculous. But the market is really loving AI and it's hating something else. And those other stocks are not going down because they're bad companies. They're going down because they're not exciting enough. And this is where I normally find a lot of bargains. So in this video, I'm going to share two stocks that I want to buy more of them in May of 2026. The first one I talked about recently. I was asked to do another video. I'm going to do another video on it. The second one is more of a value investor related stock. So it has a low multiple. It's a boring stock, but it's also growing 20 to 25% in free cash flow. So this is my style of investment. I like those stocks more than big tech and the Magnificent Seven. And it's not really well known. And I don't normally share them on YouTube, but I'm going to talk about it again. So I really hope you enjoy it as always. The first one, and I'm going to keep it short, it's Meta. I have Meta in my portfolio. I bought it recently. I would love to buy more of Meta, especially under $550 per share. But Meta has been going down recently. It did go down 10% on the earnings report. Although the earnings report was pretty amazing to me. They put in a massive beat on earnings per share, and they also beat on revenues. The company grew 33% in revenues. This is a 2 trillion plus market cap, and they're still growing 33% in revenues. This is not supposed to happen, but Meta is exceeding all expectations. And all of this is organic, by the way. They didn't do any mergers, any acquisitions. 33% all organic. Pretty crazy to me. Now, there were a few things that kind of upsetted the market and it led the stock to go down. The first one was they had their first ever, I believe, decline in daily active people from 358 to 3560. So they declined about 20 million people. The company said it's due to restrictions in Russia on WhatsApp and restrictions on the internet in Iran, and it caused them to lose 20 million people, which happens from time to time. The company with that kind of scale reaching half the global population, it's not gonna keep growing every single quarter. So I'm not really upset about that too much. The second one, which is the elephant in the room, of course, is CapEx. The company raised CapEx again to 125, 145 versus 115, 135. So they raised it by about $10 billion due to more investments and also higher memory-related cost. And the market, again, is worried about it with Meta. It's not worried about it with Google. Google's going up and Amazon's going up. But when Meta raises CapEx, the stock goes down. That's due to two reasons. The first one is Meta doesn't really have their own chip business. Amazon has Trainium and it's doing really well with the stock, and I own the stock. Google has their own TPU related business, is doing well. Meta doesn't have much hardware. Meta is more of a consumer, and those prices of the hardware have been going up, and Meta has been suffering a little bit more than others. But the second one is people still have recency bias from the metaverse, which of course was a mistake, but this is nothing like the metaverse. But even if you look back at what they did in the metaverse, when they spent 62% of operating cash flow on CapEx, now they're doing the same thing. But whenever they spend 62% on operating cash flow on CapEx, the company went from growing 2% in revenues to growing 22% revenues on the quarter, and even now it's still growing 23%, with a re-acceleration to 33%. So maybe not all of this CapEx was a waste, right? Maybe they found a lot of things with it and they were able to grow. And I think the company will do it again. But one of the most underrated part of the report is the headcount, which barely increased 1%. Whenever you have a company increasing revenues 33%, you normally see a headcount increasing 10%, 15%, sometimes even the same pace of the revenue with a lot of tech companies or software companies in general. But this is not the case with Meta, where Meta's headcount barely increased 1%, and they're even going to get rid of 10% of their workforce due to AI-related efficiencies. So operating leverage is going to kick in a major way over the next few years. And Meta is one of the few tech companies that's finding so much efficiency in in terms of their workforce and in terms of running the operations at Meta. And that's really good for the company. Now, if you look at the multiple at how much you're paying for all of this, you're paying about 19 times earnings. 19 times earnings is dirt cheap for a company like Meta that's growing 33% in revenues, and you have so many call options, such as the recent acquisition of a company called Assured Robot Intelligence, which is like a startup building AI models for robots as Meta is getting into humanoid technology. So again, there's so many call options. You have a founder CEO, he's very young, he's gonna likely be here for the next 20, 30, 40 years. He's not near retirement. So you have so many things within that company at 19 times earnings, reaching half the global population. I believe the stock's undervalued, and I'm planning to buy more of it, especially if it goes under $550 per share. And by the way, I'm using Fiscal.AI to come up with all those charts. If you want to try them out, they give you 2 weeks of free access if you use my link in the description. Now, the second stock that I want to talk about, and I talked about it once, this is GFL Environmental, ticker symbol GFL. The stock is down 23% over the last year. I started buying it recently at $39.50. I used to own the stock back in 2023. I sold it because there was some kind of rumor that's gonna get acquired, and I made like I think 20% in 2 weeks or 2.5 weeks. And I recently started to buy the stock again. GFL is a waste management company operating in Canada and in the United States. They have what I would call a physical moat. Those are assets that are impossible to replicate. You can't replicate them, you can't rebuild them. They're there and they're gonna be there forever, which is why those companies have massive pricing power, and they are one of the best inflation-related hedged companies you could own. And they have, again, a lot of valuable assets. Now, whenever you hear a company that's a waste management, boring stock, utility-like company, you're like, this is no growth. I'm a tech investor. I'm a growth investor. I want high upside. Well, if you look at the growth of GFL, the company has grown in revenues 17% CAGR since 2020. Adjusted EBITDA grew 20%. Adjusted free cash flow grew 23% over the last 5 years on a CAGR basis. So this is not a company that's a slow grower. It's growing much faster than the waste management industry in general. And on top of the landfills and what they have, they use a lot of the waste to create, you could say, natural gas. And they're converting their fleet to a natural gas fleet. Now only like 23% is natural gas. They expect to get it 50 to 70%. And once they get into a more natural gas fleet, they can use the natural gas generated from the waste that they process, and they can use it in their own trucks, which could potentially, you could say, create more efficiencies in general for GFL. GFL makes money in two different ways. The first one is with organic growth, of course. So the company grows a lot in raising prices. They have a lot of pricing power. Like they raised prices 7% in Canada, 3.4% in the United States. Then they have acquisitions because the company does a lot of acquisitions. They put in 3.9% revenue growth from acquisitions. If you exclude the foreign exchange rate between the Canadian dollar and US dollar, they grew pretty much like around 8.5%. So 8.5% revenue growth is really not bad at all for a company like GFL. And they have a good, you could say, M&A strategy where they acquired a lot of those companies in the private markets, very small acquisitions like 7 times EBITDA. And you have the big players like Waste Connections and Waste Management trading at 16, 17 times EBITDA. So you're buying those companies at 50% of the price you would be buying them in the public markets. So this is really, really interesting to me. Now, you might be asking yourself, if this is such an amazing company, then why is the stock going down 23% over the last year? Well, GFL is not alone. You have companies like Waste Connections, which is a very, very high quality waste management company. Waste Connections is also down. Republic Services, another high quality company, it's down 17%. And I put in McDonald's, which isn't really a trash company, although some people believe the food is trash, but it's also down with them. And my point is that there's an overall rotation out of this sector because I believe it's not really exciting enough. Like people are excited about AI, semiconductors, and all these things. They're selling those stocks. Some of them were overvalued, yes, but this is largely due to, you could say, money flows where people are not too excited that they want to put in the money somewhere else. And if you look at a chart of, let's say, waste management and the NASDAQ, normally they kind of inverse each other's most of the time. But again, those companies are going down, not because they're bad companies, but because the market is not excited about them. Now, there's a second reason why GFL has gone down a little bit more recently, and this is due to a big acquisition they did called Secure Waste Management, which is actually a public company, and GFL is acquiring it through a mix of shares and cash. And that was a surprise to the market because GFL was well known for being too aggressive with acquisitions, acquiring a lot of companies, and being massively over leveraged. They reduced the leverage by like 50%. And it was supposed to be that quality compounder like waste management, where they do some buybacks, some acquisitions, but nothing crazy. Then GFL comes out with a secure acquisition. It surprised the market and the stock went down. So that's mainly what happened. But I believe that was a really, really good acquisition. The company combined will have like 12 landfills, 55 wastewater treatment facilities. But Secure also has some critical energy infrastructure that's pretty much impossible to replicate in Western Canada with 3 crude pipelines, 13 storage terminals. So there's some commodity related exposure, not a lot, but they have really critical assets. And I love the critical necessity assets in the age of AI because you can't really replace them, you can't code them, and you can't really disrupt them. But the best part of it all is that this acquisition is 12 to 15% accretive to free cash flow per share. So yes, they're issuing stock, but even after the share issuance, they're going to make 12 to 15% more in free cash flow per share. Normally, whenever you have such acquisitions, the stock should be going up because it's increasing free cash flow per share 15% overnight, but then the stock is going down. So this is something that I notice sometimes with acquisitions because there's a lot of uncertainty and the market is not sure, investors are not sure, the stock sells off, and once it becomes clearer, then the stock recovers like a V shape, like it recovers in a major way. But again, it was a good deal, and it's going to increase free cash flow per share by 12 to 15%. So if you account for this 15%, the recent acquisitions, the recent company's earnings report, which was a great report, and they raised guidance for the year, excluding the acquisition, all in all, the company is trading at about 17 to 18 times free cash flow. And this is what the CEO said, which owns about 6% of the company. He said, if you look at the business, it's trading today on a combined basis, we're probably trading at 17 to 18 times 2027 free cash flow, probably 10 to 10.5 times EBITDA, when we've traded at 25 to 30 times free cash flow and multiples somewhere between 13 and 16 times EBITDA. So from our perspective, this will catch up. And if you look at other waste management companies, Waste Management, Republic, Waste Management, all of them, they're trading normally 25 to 27 times cash flow, and they trade around 15 to 17 times EBITDA. Today, GFL is it's trading at 17 times cash flow, and the company is guiding low to mid 20% free cash flow growth into 2028. I haven't seen such setup in a while where I'm getting about a 20-25% annual return on a free cash flow growth alone. But because of this acquisition, the stock is trading at 17 times. So I believe the upside from here is about a 50%, 40 to 50% re-rating on the multiple from 17 times back to 24, 25 times potentially once the market is more clear about the acquisition and it goes through after May 27th is the vote. And once it goes through, I think maybe there will be more clarity and the market will wake up to how cheap the stock is because 17 times it should likely re-rate back to what it was, about 24, 25 times cash flow, which is about 40, 50% on the upside on the multiple alone, and then about a 20% to 25% free cash flow growth due to M&A and organic and margin expansion until 2028. And after 2028, I see 15 to 18%. So again, the setup here is really compelling. Either this is one of the greatest investments I've seen in a while, or maybe it's just a value trap that's hiding in plain sight and I'm just missing it. But I researched the stock a lot And I don't believe it's a value trap. It could be I've fallen into them sometimes, but I also bought some stocks this year. Like I told you guys about the foreign stock exchange stock trading at 16 times earnings, now trading at 20 times. It wasn't a value trap. Like not everything that's a low multiple is a value trap. Monish Pabrai is still making money with coal and all those stocks. He bought them at low multiples. So I believe the merger is creating uncertainty. And I believe the flows in general are coming out of those safety stocks going into AI. But it's not going to last forever. And I just believe the stock's really undervalued. And maybe I'm going to be wrong, but we'll see what happens. And I share everything I do in my own group when I buy them, when I sell them, especially smaller caps and other stocks. And this is the link if you're interested. But thank you very much for watching. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.